Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining us. On tonight's program, I've got to test out whether we can trust this rally. So I've got Jun Bei Liu of Tribeca Alpha Plus talking about exactly that. She does trust the rally. That might surprise many of you, or maybe not. And she likes a couple of companies that you might not think look like good value, but she does think they're good value, and they're top quality companies. Then Mike Gable of Fairmont Equities looks at the actual indices, the indexes that are doing really well, S&P 500, the Nasdaq, and also the ASX 200. He looks to see whether you can believe in this rebound of the stock market. At this moment, he's cautionarily positive, doesn't deny the fact there could be a turnaround, but at the moment, there's a lot of positives coming out of the charts that he looks at closely. And he also looks at the stock, the one stock that he thinks looks like really good value. It's a gas. And then ST Wong of Prime Value. He looks at three types of investments you can make. The small cap ones, he likes some of the aged care providers there. He likes the banks as well, and some of the growth stocks, including James Hardie and Goodman Group. And you'll find out why by hanging there and listening to that interview. So that's the show. Let's kick off now with Jun Bei Liu of Tribeca Alpha Plus. Well, a lot of us are a bit surprised and very happy about the rally of the stock market right now. Let's just see what Jun Bei Liu sees in the rally and how she's playing it. Jun Bei Liu, good to see you.
Good to see you, Peter. Thank you for accommodating me speaking from the car.
Oh, we're a mobile world, you know that nowadays. Jun Bei Liu, tell us, this rally, has it surprised you, the strength of it over the last few weeks?
Look, it hasn't really surprised. We've always said, like you and me, we talk about this for months now. We know the market positioning was way too pessimistic, and a lot of valuation crunch has already been done early in the year. And it's really about earnings. If the company can do earnings, their share price will go higher. So, we think that this rally just been, quite a few months in the making. And a lot of people are calling sort of the end of a, bear market rally and things. Honestly, the Australian share market actually has done pretty well since July till now. I think it's up something like 6-7%. So it's not a bear market rally, and I think based on what's happening now, I really think the share price is going to grind higher.
Okay, so will the critical points for either reinforcing this rally or questioning this rally be the jobs number on Friday in the US and then the inflation number next week on November 10?
Look, both of them has possibility to create more volatility, so market may have a wobble here and there. But honestly, I don't think anything is surprising. We know the inflation number is going to be continue to be strong, but it should start to come off as we have seen in the last month. We've seen the job number was still showing reasonable number, and based on what we heard from the corporates in America, the economy is going okay, and but the inflation is probably somewhat heading downwards. That's pretty much being expected by the investors. Okay,
so what have you been buying in the Australian market over the last week or two?
Oh, plenty. Look, we just seen lots of opportunities. As we touched on before, we think a lot of growth leaders are looking cheap. So things like Domino's, yes, they're potentially to be another downgrade to come because Europe is doing pretty tough, but it is it's a structural growth business, and business in a better position will buy more of those. Actually at the moment, there's another business looking very interesting, which is Medibank. Clearly, they had their issues with with the security breach and things, but share price down something like almost 20%. This is actually quite a bit of value being wiped out. Yes, there potentially will be, class actions and things like that. But, for 20% of market valuation to be wiped out, this is does represent some of the shorter term opportunity for this one. Remember, this company was rumored to be taken out not very long ago, and always had corporate interest. And the company is sitting on really strong balance sheet. And then the dividend yield before the fall was something like high single digit. So this is companies, got a solid balance sheet, good brands, in a stable business, stable market share. It's and for the market cap to be down 20%, definitely worth a look.
So I guess you're saying the sell-off was a panic sell-off. The true loss to Medibank will be seen if people leave Medibank and go to HCF and NIB and all that, their rivals. And I guess we don't know, like some people might be saying, well, they've made a mistake, they're going to be really protective of their data going forward. Do you think that's probably a bit of the thinking?
Oh yeah, it's a bit of thinking, and clearly market share loss and the like will be an issue. But for something like that to take place, it probably means, as we have seen with many other Australian corporates, it probably means the other competitors like NHF and things, they might be under threat as well. So just means that everyone will spend a bit more on internet security, and not a bit more, a lot more, and those targeted attack does seem will recover over time for banks, for Medibank.
Well, one of the interesting revelations out of the S&P 500 last week was a lot of the more conventional companies are doing well, and the tech companies are yet to take off. Do you think that same problem is happening here? When you look at companies I know you like Xero, I think you like NextDC as well, don't you? They're still struggling to take off, but when there is a rotation, are they the companies that you think will be the big beneficiaries?
Oh, absolutely. And also, remember the US tech, the consumer tech. So, their earnings being sold off because, the earnings being downgraded. So, whereas things like NextDC, we actually think they are very close to winning more contracts. And if they do, the share price will run away. And if anything, we've seen some M&A taking place in the US market at valuation very much higher than what NextDC is sitting at. I actually think that one is a standout buy. And then it's really a lot of bad news is in the market. The valuation will only have to head higher.
Okay. Are there any other sectors that you've got really keen on in recent times? And if so, what have been the star stocks that you've been chasing?
Look, I must say, I'm one of those contrarian. I do like to look at things when they get sold off quite a bit.
Yeah.
One of the interesting sector is that, we talk to the tech, talk to the healthcare, but this one, which is Woolworths, the supermarkets, they've been sold off a lot for a large supermarket to be down this much. Look, clearly they are, COVID beneficiaries, all these things we know, but the share price is actually coming down to quite reasonably attractive levels. For Coles, it's under 20 times, something like 18 times earnings. And remember, these supermarkets will have a very good Christmas because this is the first Christmas that we can actually celebrate without any form of restriction. So I actually think Christmas is going to have a good Christmas. Supermarket is going to have a great Christmas, and it does look pretty attractive at this point.
Okay, so if for example we do get a disappointing inflation number in the US and the market sells off, are you going to be an aggressive buyer?
Oh, absolutely. I think we're getting very, very close to that bottom of the market now. Remember, share market always forward-looking, and we're probably looking at the economic data to get to the worst by early next year, and that means the share market is very close to bottoming now.
Great stuff. Good to see you, Jun Bei Liu. Now, before we go, you are associated with a foundation, is that right? And you've got a special function coming up. There's only 5 seats left, I believe. Just tell us about the foundation and what kind of people will be at this function.
Look, absolutely. Thank you, Peter. Look, this is for the RAISE Foundation. RAISE is a charity that help young adolescents to find mentors. And they just find the incredible amount of demand from high school, public high school, and kids wanting to talk to people. This is just mentor from every field, whether it's, just to talk about things or whether it's for career advice. It's about everything. Look, the foundation has done really well, and they got so much demand, and they're coming to the year end. As you know, all the charity is going through a bit of a tough time. So I put together this lunch to help raising money for for a race, so they can go out and help more young people. Now this lunch is has been organized for around 40 people, only 5 seats left. We got some very well-known fund managers around. We've got hedge fund manager, we've got financial advisors from different advice shops, and then we've got we actually have the CEO of Hearts and Minds attending. We've got ladies from Future Generation, so there's a lot of charity attending. So look at this; it's a very interesting event, and help us to really support those young people.
So you'll be there, of course, and a whole lot of
Absolutely.
fund managers. So if anyone wants to go, it's not cheap. It's $2,000 a seat, isn't it? But it's for a really good cause.
That's right.
There's only 5 seats left. Where do people need to go if they're interested in attending?
Look, they just need to go to, they will need to email, go to Tribeca and email Tribeca, reception@tribeca.com.
So reception at Tribeca.
tribecaip.com.
Okay, great stuff.
And then we'll help you out.
Okay, fantastic. We'll put that up on the screen as well. Good luck with that, and thanks for joining us, Jun Bei Liu.
Thank you. Thank you.
With the market rebounding and surprising a lot of people, I wanted to get to Mike Gable to see whether the charts are saying that this is a believable rebound, or is there something out there that could go wrong. Mike, great to see you.
Thanks, Peter.
So you're looking at this rebound. Are the charts giving you confidence that this can last or not?
It does look like the market wants to go higher in the short term, but that's all we have at the moment. So we spoke a couple of weeks ago. The market had given an initial bounce, but I just wanted to see that it was actually going to hold at those levels, and then feel confident that we might have a tradable bounce.
Yeah.
And that's what it's doing at the moment. I think anything more longer term, it comes, we sound like a broken record, but it comes back to inflation data, what interest rates are going to do, and we haven't had any further clarity on that. We just have a market that is at the moment thinking, well, the numbers have been pretty bad. Hopefully that's as bad as they will get. So this is what we have at the moment, I think.
Rudy Philip Van Dyke always says hope is not a strategy, but still people do trade off it. Let's go to the charts. I've asked you to look at the S&P 500, the Nasdaq and the ASX 200. What are we seeing? Let's go.
Yep, so S&P 500. So daily chart here, what we're looking at a couple of weeks ago was we had sort of an initial bounce. It didn't follow through. So as a recap, what I was explaining to viewers at the time was you need to see a bit more evidence that a low's in place. So any of the other lows that we were able to trade, the similar feature for each of them is you get this sort of higher low. So the market comes back, does a bit of a retest, and is happy to kick on. So what I've circled here was what was, in my opinion, that higher low. So once we're at this point here, it looked like, okay, well, the market wants to bounce. Whether this is the low or not, we don't know. But looking pretty good. I've got a couple of squiggly blue lines, moving averages. So the main ones to keep an eye on, it's always the 50-day and the 200-day moving average. So when you get above the 50, that's again another box tick that, okay, the market's looking like for the moment it wants to head higher. So on Friday night, it bounced off that level. So look, so far so good. Unfortunately, we're still under the 200-day moving average.
And once we hit that, that's when you can be really certain that this is a really believable rally. Yeah,
if we can get above that and hold for a period of time, you can get a lot more confident. But it can trip you up. I mean, we did see in March this year, we got above the 200-day moving average, and 2 weeks later we're back below it. So it can happen. But I think if you get the combination of that happening with more confidence that interest rates aren't going up, so a few more again boxes to tick. So look, I think we're getting towards the end of this dark tunnel. Maybe a little bit further to go, but for the time being, I think there's a bit of upside here. So
it seems to me, Michael, that we're seeing like a sneak preview of what will happen once we do believe inflation is on the way down and interest rate rises have either stopped or going to be smaller in the future.
Yeah, exactly. And look, I mean, we were buying some things last week. I mean, my opinion is when you get these bounces, you can sit back and say, well, it might just be a dead cat bounce. I prefer not to participate. But my opinion is that you get these bounces, they may well end up becoming, you know, a proper rally. This may well end up being the low. We might find the market rallies here, and then even if we're not getting any confirmation of interest rates staying put for another several weeks, the market may well consolidate and then get going again. So this could be the low. And what you need to do, in my opinion, is when you get these bounces, you need to give it a go. I'm going to run a tight stop on anything I've bought. So if it starts to fail, I'm out. And maybe that happens to me a few more times, but eventually I won't get stopped out and it'll just keep going and going and going. And those who decided to wait for all their ducks to line up will end up with a market that's already up 30% and they've missed the best of the opportunities.
Okay, let's go to the Nasdaq, which of course is the most overreacting market for obvious reasons. It's got a lot of tech stocks and growth stocks in it. Is this showing a similar pattern, mate?
Similar to the S&P in that, you know, in terms of what it's done here, looks the same. But those viewers with a keen eye would have noticed that the Nasdaq is still below the 50-day moving average. Yeah. So looking a lot weaker than the S&P. In terms of the Dow Jones, I don't have the chart here, but the Dow Jones is basically up here.
Yeah,
so I think it's at its best October in a very long time. So again, that just
1976.
Shows, well, there you go. So again, that just shows the effect of all the technology stocks we saw last week. What happened with Microsoft and Amazon? Yeah,
and I think also the interesting point is being made that where tech was dominating S&P 500, and of course dominates Nasdaq, it's the tech companies that actually are making profits are the ones that are doing well, and the ones that are still out there waiting for it to happen, they haven't been picked up at this point in time.
That's right. They'll take a bit longer to get going again. Okay,
let's go to a big beneficiary of 2022, up about 240%. Whitehaven COL.
Whitehaven COL.
Is this due for a sell-off, mate, or can people who hold this stick on with it longer?
I mean, my opinion is you stick with the trend while you have it.
It's a pretty bullish trend, isn't it?
It's still an uptrend.
Yeah.
I'm looking at higher highs. What I've done is have a look at some major moving averages to see which one fits best. Because my opinion is you stick with it, and then when the trend is over, get out. So I think the 50-day, this is what I've got here, tends to the stock tends to respect that very well. And if I was trading this, I'd be using this as my line in the sand as to when to get out. It's getting very close to it, and occasionally you'll have situations where it goes under. So the trick here is you need to be a seller, but then have the I guess the guts to get back in at a higher price where you sold it, knowing that the uptrend is back on. Yeah. You don't just sit there and think, oh well, I can't buy it for more than what I sold it for.
Easier said than done, that one, isn't it, Michael?
Yeah, yeah, but you know, you need to just think, well, this is a new situation, a new trade.
Yeah.
But apart from this situation here, it's you know, I think the 50-day is a good one to look at. It is coming back to it. So the next, I mean, as we speak, it might be just dipping under it now, but I think tomorrow could be the day where you need to make a decision. Looking at the way Whitehaven COL consolidates, the last few times it has sort of consolidated sideways, and then it has this sort of dip here before rebounding.
And there'll be profit takers. There'll be profit takers realise they've done well.
Yeah, exactly.
And they come again.
So look, I just keep an eye on a 50-day for our viewers at home, and you know, I think if it cuts under it tomorrow, just sell it and just watch on the sidelines.
Just sell it.
Yeah, because it might do this. Great, get back in. But that might be the top, and then maybe it comes all the way back.
I guess if you believe that Vladimir Putin is going to be a pain in the neck for quite a substantial amount of time, you can punt on energy prices being high and Whitehaven Coal being a beneficiary. But once that war's over, then I guess you want to be out.
Yeah, look, I think the whole energy sector's got further to run.
Yeah.
And
what was the budget projection? 56% increase in energy prices over the next 2 years.
Something like that.
Because that's good for Whitehaven.
But of course, this move has been on the back of not just the rising coal prices, but everyone else extrapolating out high coal prices next year. There's the massive buyback on at the moment. So potentially a lot of that's already factored into the price, and maybe it needs to consolidate back here before it gets going again. We don't know, but I think this is a very objective way to look at it. Just run the moving average.
Yeah, those who have made plenty of money probably can run with it. People who want to get in now, it's a bit more risky.
Yeah, exactly.
Let's go to the next one now, mate. And this is one from my Boom and Doom show for the Switzer investors. Neuron, is it Neuron Medical?
Yeah, not one I follow.
It's not a well-known one to me either.
Yeah, but it's look, this one's doing all the right things in my opinion. So we've got that uptrend, quite simply, higher highs, higher lows. You definitely stick with it. If it breaks one of the old lows, that to me that's the sell signal. So that's around here. I think that's around 660, something like that. So far so good, doing pretty well. What I found interesting on this chart was another example where when you see a stock break to a new high, you shouldn't be scared of that. So here we had a situation, and I wish I'd seen it at the time, where for 6 months the share price had done nothing, and then suddenly it had this huge day up where it broke to a new high. The highest
it's like someone knew something.
Yeah, the highest it's been in about 6 months, and it looks like it traded from around 440 to about 490. So it looks like a 10% move on the day. But as you could see, that sparked the start of the next trend. So I wouldn't be worried about buying stocks at an all-time high, because you don't have trapped sellers above you. Everyone's making a profit. Everyone's happy to continue backing.
So it's something that people should do their homework on. But certainly at this point in time, the price action indicates it's heading in the right direction. Yeah,
that's right. If you're looking to buy it, I'd if I saw weakness back down here, I'd buy and then have my stop loss at that prior low.
Okay, good hint. Now, next one, Integral Diagnostics, another company I don't really know much about. I get the question a lot. So what's it telling us? It doesn't look too good.
That's right. So the opposite of the other stock, unfortunately. The main thing I've noticed is what it's doing around here, and I've got a feeling it might trap some people. And the reason why I say that is we had this huge rally off the lows in July, and then it slowly crept all the way back to that July low. Now, I'm guessing that a lot of people would look at this and think, well, hang on, that's a pretty good support level. Yeah. Maybe we should buy it. I think the opposite's true. So if this was bullish, if this was basically a low in the stock, it shouldn't really be all the way back here. I mean, it should, by the time it's got only, not even halfway back to these prices, you should have seen all the buying come back in. So the fact that it was able to get all the way back down to this low, it bounced, then it's back to that low again, it's bounced back to that low. That's to
there
me,
are a lot of
that's
downers on the company.
So I wouldn't be surprised if this week that level breaks and then everyone sees that break and they start to panic. So for those who want to see a recent chart of a stock that's done something similar to this, have a look at Sandfire Resources. That was another stock that was loitering at support, whereas it should have been up there. It shouldn't have been down there, and it broke support, and at the moment it's struggling. So I'd be very.
And it's a big drop from glory, isn't it? We're talking about a $5.40, 50 stock, and look where it is today. It's a very big kick. Yeah. So once again, if you're interested in this company, you have to go do your homework. Another company, which is a great company, I think, Xero. Let's have a look at that now. It's been struggling. Is the chart giving you an idea that they're going to get out of the struggle street situation? Yeah, it is still struggling. So we do still have that downtrend. There's a little bit of positivity here in that it's
it's sort of holding on at these levels. It might just need to base a bit longer, but still early days, I think. So
I've always figured this is a company that will be a beneficiary once tech is forgiven in the US. Like they'll come to Australia and say, well, this is a company, if they're not making profits, they're close to making profits. They're a progressive company, they're not really a startup. But it just seems to be suffering the fact that tech is still on the outer. There's no strong rotation to tech. But the day it happens, when it happens, I suspect this is one company that'll take off.
Yeah, the quality ones will move first. But at the moment, no one's participating yet.
We can't give a leg up on that one. Another similar company, which actually does make profit, is NextDC. Is it sort of showing the same kinds of hovering around a bottom?
Not quite. Even if this one is making a profit, it's still definitely in the downtrend. And what I've noticed here was another example where there was a bit of a trading range up until about September, where again there was a very clear support level. Every time we tried to bounce off it, it just went all the way back down to it, which again is not a sign of a strong support level. It's a sign of a stock that's really struggling. So I think as soon as it broke that line, that was the sell signal. So
and it's interesting, Mike. We know that the market hit a bottom in June, and it bounced off it, didn't it?
That's right.
But then once it got to around August, where a bit of negativity crept back in the market, it really was big negativity, wasn't it? Looking at that.
Yeah, that's a good pickup. So the fact that this is the low in June, our market is here. NextDC has really underperformed in that period of time. So just on another stock, we don't have a chart, but on that whole topic of tech stocks, those that are making a profit and therefore might show signs of relative strength, one that I like the look of is WiseTech. So WiseTech is actually I think it's only within $1 or $2 of its all-time high. So the fact that it's doing that in this sort of market is a very, very good sign.
Yeah, so
that's what we'd prefer to see in these ones as well.
And it's kind of got out of the tech space. It's a tech kind of company, but it's a real business. A lot of people like it. Okay, so we're going to go your pick now. And our final one, and I'm not surprised you like Beach Energy after you showed me the Whitehaven chart. What are we seeing here, mate?
So I still think energy can do well next year, and I think it's in terms of Beach LNG sales, I think it's worth getting back into this one after the recent pullback. So something I've noticed with this particular chart, although it is quite messy, in my opinion, there was a fairly clear downtrend line here, so a fairly clear line of resistance. And the fact that it's quite clear to me means that once it gets above it, that's a buy signal. So apart from that downtrend line, the other interesting thing I've noticed with the recent price action is after the low in September, it's managed to creep upwards towards this converging point. You've got this outlier.
Yeah, wait, I was going to ask you though. It looks as though it's an incorrect addition to the chart.
Yeah, the addition of this is what makes it very interesting. So they had their quarterly update, which on face value
wasn't great.
Maybe wasn't the best. And what this candle indicates is that the share price opened all the way down here, so it got smashed on the open. But by the end of the day, it basically had recovered almost all of its losses and was just back into that range, and then it never looked back. It continued on. So this shows me that on the main occasion where investors had the chance to sell this, they were just steamrolled by all the buyers. So that's a very bullish sign. And now it's popped its head above that downtrend line. So I think as a trade, this is the buy signal. This is one that we picked up last week, and I'm expecting some sort of recovery here. So hopefully we're in for a decent amount of time, but as I mentioned at the beginning, I'd rather just run a tight trailing stop on these things. At the moment, I don't want to take more than a 10% loss if I've got it wrong.
Is that what your stops are usually 10%?
In this market, I'm going to run them pretty tight. So at the moment, I've got a 10% stop, but then once it gets going, I'll start to to tighten it up. Hopefully, what happens this week with interest rate rises and the associated commentary doesn't spook the market.
Yeah, that's right.
Yeah, we can get a bit more of a rally.
Yeah, okay. Well, thanks for the insights, mate, as always.
Yeah.
That's Mike Gable of Fairmont Equities. Well, the market has been rebounding, and to see whether we can trust this rebound, we're talking to ST Wong from the fund manager Prime Value. How are you, mate?
I'm good, Pete.
Well, we kind of expected a rebound of sorts. Has it come a bit earlier than you expected?
A little bit early, to be frank, Pete. The Fed's sending somewhat mixed messages from being hawkish to less hawkish, and the market's taking a positive turn to that. So I think it surprised everyone, to be frank. I don't think anybody's really got onto this rally in a big way.
No. And do you think a lot of people are saying to themselves, I know I'm saying it, I do want to see that inflation number on November 10 before I say, yep, I'm a true believer?
Yeah, look, from a headline perspective, I think the number, even the previous month's number is going to be quite challenging for the market to stomach. I'm in a camp whereby I'm planning for a variety of scenarios to emerge from that and, try to play with the cards that's been handed to me and work from there onwards.
Yeah. Yeah, I'm totally with you. As you know, I've been saying that I wouldn't be surprised to see a rebound in the December quarter. I always thought that the market would wait to see the jobs number on Friday and then wait for the inflation number. And so it's going to be very interesting the next 10 days or so.
Yeah, I think so. I think to chip into that, Pete, is that, it feels that the market wants to rally into year end, and I suspect that's what's happening at this minute. And I think it all seems quite reasonably positive, at least on the sentiment front. That's my own gut feel. Nothing scientific to it.
Yeah. I guess it's fair to say US corporate season's a bit better than expected, which is kind of implying maybe the recession fears were overdone. And secondly, some of the economic data is actually pointing to the fact that inflation might be falling, but we don't know how much it's falling by. I think that's going to be the critical issue. If it is a big fall in inflation, well, this rally is justified. If it's not, it could lose a lot of wind.
Absolutely. Agreed on that one.
Okay. So how are you playing right now? How are you investing? What looks like good value for you?
Yeah, look, Pete, from where I sit, I continue to hold a diversified portfolio. What I mean by that is that I'm trying to position in a variety of scenarios that could emerge. On one hand, I really don't want to be too bearish, and part of reasons we get these rallies that we're seeing in October, right? The S&P 500 is up like double digit or thereabouts, or 8% or thereabouts.
Yeah.
And on the other hand, I don't be overly bullish in case I'm wrong in my view. So I think I've spoken to you before. I try to look for ideas, opportunities in different buckets. And in this market, there'll be opportunities across a different variety of ways. And that's how I'm playing it, or how I'm positioning myself in the current environment.
Yeah. You might not use this terminology, but though you should, given the name of your fund. Are you playing value stocks now, or value stocks and growth stocks? Because that's interesting. I know that the S&P 500's had a nice rebound, but it's mainly been powered by value stocks rather than those tech growth stocks. What kinds of Aussie companies are you chasing?
Yeah, absolutely, Pete. Look, I'm not a value hound, despite the name Prime Value. So I'm quite balanced in my view. So if I take you through maybe 3 examples to give you an idea of what I'm hunting for, so to speak, in this environment.
Yeah, great.
Look, I'll kick off with some small cap companies. Aged care sector. That's coming across as quite interesting. The likes of S-Tier and Regis Healthcare. The ticker codes being EHE and REG respectively. Aged care providers got really affected through COVID because of occupancies, as we all know. We saw those media images, right at the start of COVID-19. I think that sector is starting to come back. Occupancy is starting to rise from about 86% currently, and it's got a structural theme in terms of aged care provision. And we all know that the market's really quite in need of aged care beds, so to speak. So that's one sector which has been really been affected through COVID. I think that's starting to come into fore, especially into 2023, for three reasons. Occupancy should begin to rise as COVID-19 recedes. Secondly, the cost of replacing a bed in aged care is actually rising quite substantially. So it is really pointing towards consolidation in the sector. But finally, we're also seeing regulatory concerns, I guess, ease because aged care fees are actually rising for each of these providers on a per bed basis. And that should underpin quite a bit of revenue through flow into the next 12 months and beyond. So the aged care sector, I think, is quite interesting. And that's probably my value bucket. It's not trading expensively because by and large, the market's quite concerned on regulatory issues. I think that will ease into the next 2 years with a structural tailwind behind the sector.
Okay.
So that's really number one. In the shorter term, I have been buying banks into the results, and that's more a tactical positioning. Rising interest rates have proven to be really positive for the banking sector since June this year, and we will see that coming through into the next 6 months, so to speak, as rising interest rates benefit the banks into higher mortgage rates rather. So that's one from a shorter term perspective, which I've been putting money into. I think that trend will continue into the new year. I think the banks will be quite well supported, at least in the near term.
Which one, yes, too, looks like the best value to you? Because we know the CBA is always a very good bank, but it's always priced to perfection. Which one do you think offers the best value?
Well, Pete, I've held NAB and CBA for a number of years now. And even in my most recent acquisitions, there's still been a CBA and NAB. Look, I think from a perspective of how banks are valued, we all know that CBA is really expensive. But what I do really like is that the business is really doing really well. And I think that will support earnings growth into the next 2 years.
Yeah.
So that's why I've continued to put money into CBA, even in the near term. NAB, again, doing really well. Momentum still with the bank. On a franchise perspective, mortgages continue to do well. Not as cheap as ANZ or Westpac, but we know that ANZ and Westpac does have issues in turning around its businesses. So until I'm comfortable with the turnaround of NAB, of ANZ and Westpac, I'm probably in the sidelines on these two cheaper banks at this juncture.
Okay. Let's go to your third bucket.
Well, third bucket is obviously, in my view, some of the growth stocks sold off aggressively into the market, and I continue to hold some of these in the portfolio. James Hardie and Goodman Group comes to mind, especially if you look into next year. If you think that the Fed is about to ease off the pedal in terms of interest rate rises in the US, then James Hardie and Goodman Group will be quite prime to benefit from an easing of interest rate, at least a leveling off of US interest rates into 2023. So these are fundamentally world-class companies, very strong management teams, excellent balance sheets, and in my view, they've come down to valuation which looks really attractive.
Yeah.
So James Hardie is probably trading about 15 times earnings, and Goodman Group are not too far off, probably in the high teens. So these are the sort of growth stocks I've been looking to acquire in the current market downturn.
Yeah. And they're the kinds of companies you want to have in your portfolio over the long term anyway. So if you can get them at good prices, why not? ST, thanks for joining us. As always, thanks for your insights. Talk to you later. That's ST Wong from Prime Value. And that's the show for tonight. Thanks for joining us. We're back on Thursday, of course. And don't forget, if you want more insights, the kind of stuff that we don't always talk about on the show, go to switzerreport.com.au. Thanks for joining us. See you on Thursday.